How to invest money in the stock market without lying to yourself. Have you ever noticed this strange contradiction? Most people say, I want to invest. But what they really mean is, I hope money grows somewhere without changing my life. And that gap between hope and behavior is where most stock market mistakes quietly live. Let's slow this down and make it real. Imagine a fairly normal situation in the US or Europe. You're in your mid-20s or early 30s. You earn, say, $4,000 a month after tax, or around 2,800 euros in Europe. Rent or mortgage takes $1,400. Car payment, insurance, fuel, $500. Groceries and utilities, $600. Student loan or personal debt, $300. Subscriptions, phone, small comforts, I deserve this spending, another $400. By the end of the month, you're left with maybe $800. That's the money people think they'll invest. But here's the uncomfortable part. Most of that $800 never actually reaches the stock market. It leaks. A weekend trip, a new phone on installments, credit card balances quietly rolling forward. And then comes the sentence I hear all the time. I don't earn enough to invest properly. That sounds logical, but it's not fully true. The real issue isn't income, it's how the system trains people to treat investing. The hidden financial mistake most people make is this. They treat investing like a reward instead of a system. They wait until life feels stable, until debts are smaller, until salary increases, until next year. But the stock market doesn't reward waiting for comfort. It rewards time. Let's do boring, honest math. Say you invest $300 a month into a broad stock market index, nothing fancy. Historically, long-term returns average about 7% after inflation. If you start at 25 and continue for 30 years, that's roughly $365,000. If you wait just 10 years and start at 35, investing the same amount, you end up with about $170,000. Same effort, same monthly sacrifice, almost half the outcome gone, not because of bad decisions, but delayed ones. This is where psychology matters more than finance. People don't avoid investing because they don't understand stocks. They avoid it because investing forces an identity shift. When you invest, you're saying this money is no longer for my current self. And that's uncomfortable in a culture built around immediate relief and visible upgrades. Cars, phones, clothes, these deliver instant proof of progress. Stocks don't. For years, investing feels like nothing is happening. Numbers move, emotions don't. So people unconsciously prefer debt-backed lifestyle upgrades over invisible ownership. And here's the long-term cost if this pattern is ignored. You don't just lose money, you lose optionality. At 45, the investor has choices: fewer working hours, career flexibility, emotional calm. The non-investor still depends entirely on salary, tolerance of stress, and physical energy. This isn't about becoming rich, it's about reducing fragility. Now let's shift perspective. Financially intelligent people don't think the stock market is a casino. They don't chase hot stocks. They don't talk about timing. They see stocks as delayed income. When they invest, they're not predicting prices. They're purchasing tiny pieces of real businesses, quietly, consistently, and unemotionally. They accept boredom. They accept slow progress. They accept that the reward comes later. And because of that acceptance, the system works for them instead of against them. So how do you actually invest money in the stock market? Not with clever tricks, not with motivation, and definitely not with pressure. You invest by deciding calmly that a portion of your income belongs to your future before lifestyle gets to negotiate. You automate it. You keep it boring. You let time do what effort can't. No hype. No guilt, no fantasy, just clarity. If this way of thinking helped you see investing a little more clearly, consider subscribing.